Hi, this is Class 12 of Value Invest Asia Beginner's Guide to Investing in the Stock Market. How to screen for a stock. Hi, welcome to Class 12. This is how to screen for stocks. As usual, our usual disclaimer, and I want to share with you guys a more practical way of how to screen for stocks. I want to share with you the actual tools that I use when I'm screening for stocks. So some of the free screener that you can use, if you download our PDF, you should be able to click on the links. Like Financial Times has a pretty good global screener. Another one you can use is maybe in Market Insight, Market In and Out. You can try it out. Investing.com has a screener as well, but that's more for the US market. And if you're interested in local markets like Singapore, SGX has their own screener called StockFacts. You should definitely check it out. Or if you're interested in Bursa Malaysia stocks, Bursa Marketplace has a good screener as well. And also check with your brokers as well. A lot of brokerage has their in-house software, and some of them are actually pretty good. So do check with them, see if there's any option for you. If you want something in addition, if you want more data, some of the paid screener you can decide is something that's more affordable. Is Share Investor is something that I tend to use on and off as well, or other more professional screener can be like Bloomberg, S&P Capital IQ, FactSet, or even Thomson Reuters. But do bear in mind, these are like fairly expensive for retail investors, and it's not necessary, I would say. Sometimes even the simple free screener are more than sufficient to do the job. And after we scan through the companies, if you're interested in just a local context like SGX, the StockFacts even provides their financial data as well in SGX listed companies, similarly in Bursa Marketplace. And if you're interested in Hong Kong or China listed companies, aastocks.com is a good portal that provides you a lot of information and financial of the companies. Or even if you still can't find them, Morningstar.com definitely should have some data on almost any listed company globally. So these are the portal that I use when I'm trying to find financial data of a company I want to research in, something that maybe it's beneficial to you as well. So I would just want to spend a little bit time on looking at what criteria we should put in when we are screening for stocks. Of course, we talk about the 3 types of value to be found in the stock market in previous lessons. So if you're a deep value investor, it's something that resonates with you and you want to be such an investor. These are just sample criteria. Do bear in mind, as you learn along the way, you can come up with your own criteria. But maybe I'm just sharing with you some of the starting step that you might want to consider. If you're looking at deep value, you want it to be at a very cheap price. So you want to search for companies with maybe price to earnings below, say, 12, price to book definitely below 1. But you also want to put in criteria such as net debt to equity below 1 to make sure that this company have a strong balance sheet and they do not pose any risk to you as an equity investor. Next, if you are a dividend investor or income investor or a current earning investor, you want company that is able to grow consistently, have some free cash flow, and they have very stable and consistent profit. So maybe you want a company at least to be profitable. So their net income maybe over the past few years should be more than 0. They should at least be growing a little bit. Their growth rate should at least be positive, and you don't want to invest in company with the negative growth rate. It might imply they're going through a downward spiral. So these are companies you want to avoid. If you're a dividend investor, you want them to have some dividend yield. So putting in a dividend yield requirement is good. Return on equity, you want it to be at least stable, or you want it to be at least of a certain range, say 10%, to make sure that they are quite a stable company that's able to generate profit from itself. Lastly, again, you want it to be able to service its own interest and debt, and make sure that the cash coming from the company is not affected by its debt. So you want maybe their interest coverage to be sufficient of more than 5, or other figure that you are interested in. So these are some of the sample criteria you might choose if you are an income investor. And if you're a growth investor, you want to focus on the growth, right? You want the company to prove that they are able to grow year after year. So maybe you want a criteria such as their revenue growth rate over the past 5 years is at least 10%. Similarly, on their bottom line, their earnings should be growing as well. You don't want to fall into a company that the revenue is growing so rapidly, but the earnings is not catching up. You also want it to have a decent return on equity, say 10%, because you want to make sure that it's able to reinvest in itself and grow in the future. Lastly, again, you want it to have a strong balance sheet. That's why net debt to equity, or if you want it, interest coverage should be sufficient for you. But we have to understand, screening is only the first step. Okay, we screen for stocks to come up with a list of companies that we might want to research on. It's definitely not the list that we should invest in after we screen. Okay, I couldn't emphasize that more. Screening is always the first step. Don't rush to just buy the company that come out from your screening results. A lot of time, if you screen for the whole global market, you might still come up with a few thousand or a few hundred companies. And how do we make sure that we spend the time on companies that is worth researching on, and maybe have a way to discard the company that is not interesting to us? We come up with the rules called the Fivefinger Rules. The Fivefinger Rules basically said that out of the 10 questions here, if a company that, when we go through this checklist, when a company is able to at least meet 5 of these 10, we can decide to spend more time to research on this company. If the company can't even meet 5 of the 10 rules here, maybe it's a company that shouldn't be of our interest at all. Okay, so these 10 questions can act as a checklist for you. Number 1, can you even understand the business? A lot of us get very excited in investing in companies that might be very complicated, but as a rule of thumb, always invest in company where the business that you can actually understand. There are so many thousands and thousands of listed companies for us to invest. Why should we spend time to invest in a company that where we can't even understand its business? So number 1, find a company that we can understand the business. Number 2, does the company has decent track record? We want a company to at least have a few years of track record as a listed companies. That being said, means that we should avoid new IPOs. In a way, we want to see them and the management act out as a listed company. What's their action and what are they able to achieve as a listed company? We want to see that they are able to survive at least for a few years as a listed company. Okay, the next one is the company making any money? The objective of companies is still to make a profit, and as an investor, we want to invest in that profit. So we should look for company that is at least making some profit. Number 4, does the company has a worthwhile profit margin? Sometimes when the company has a good profit margin, it kind of hints to investor that they have a strong pricing power. Say if you're looking at Apple versus say Samsung, you can see that Apple definitely has a much better brand. And from its profit margin, you're able to see that the company has a much better profit margin. And with that, we can make the conclusion that, wow, maybe Apple is a much better company to invest in versus Samsung. And so definitely look for company that at least have a worthwhile profit margin. Next is a company, will it be able to continue to be profitable in the near future? We can sort of look into this by reading news about the company, about the industry, or from the management discussion within the annual report, give us a sense of where the company is heading and if it's able to survive and continue to thrive in the future. Next is, does the company has a strong balance sheet? This is a very important point. We as equity investor, we are investing in the equity of the business, and if the business is filled with debt, there's a chance that when they go bankrupt, all that's left is only for the debt holders and the bond holders. And we know that bonds and debt holders definitely have a higher ranking above equity holders. So in order to protect ourselves as equity investor, we want the company to have a strong balance sheet. Next is there excessive shareholder dilution? A company can grow, definitely they can grow very big, but if they are doing it at the expense of shareholder by taking in more and more equities of the company just to grow the size, the per share basis for the shareholders might not grow at all, and they might even diminish. So from a shareholder point of view, we want the company to grow, but definitely not at the expense of shareholder dilution. Next is, does the company consistently churn out free cash flow? We want to invest in the company that is at least able to return back the cash to us. When we invest our cash to the company, we want a company that's able to go out and make money and able to generate back the cash back to us. So having a free cash flow is important. Next, does the company has a decent return on capital? When we talk about return on capital, we're talking about things like return on equity, return on asset, return on invested capital. We want a company that is able to generate a decent return on capital, say at least more than 8 to 10% above that. It shows us that the company is able to reinvest in itself and find new opportunity to grow at a decent rate. If a company only has a return on equity of, say, just 1%, is it worth investing in? Especially if you can find risk-free investment out there at 3-4%. Why should we even invest in a company with a return on equity of 1%, right? And lastly, I think this is more suited for Asian investors. Is the shareholders, major shareholder, reputable? We want to invest in a company where the major shareholders treat the minority shareholders as equal partners. In Asia, in particular, corporate governance is a big issue. Many companies, even listed, are still run as family-run business. There's nothing wrong with that. But if the family-run management or the main shareholders only see that the extended family as the partners, but rather see minority shareholders as just a nuisance, they might not act in the best interest to minority shareholders. And that's very important. We want to make sure that the major shareholders or the managers do not have private deals within the companies among themselves, or they have a huge amount of related party transactions, or they have a huge salary for their family members within the company. We want all that to be at the minimum to make sure that the major shareholders and the managers have a good reputation in the market of being fair to investors. Hi guys, thanks for watching the video. Remember to click on the link down below to get to all the Rise Up, and you'll be able to download even the slides and the podcast as well. I'll see you in the next class. Thank you.